Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So what I'm going to do today is look at 5 different companies that are in the cloud computing sector. I really like the cloud side of things. I like the technology side of things. So we're going to look at the 5 companies, see if they're actually worth investing in our portfolios and so on. But before we do that, as always, I would really appreciate if you can join us in the Patreon account, where you get access to the Discord, where you get access to all of these things, including the family portfolio, the Sharia compliant investing ebook, and so on. Inshallah, if you could do that, that would be absolutely amazing. So what I did is I looked at this ETF called Fidelity Cloud Computing ETF, and it has basically loads of course different companies, and some of them are Sharia compliant, some of them are not Sharia compliant. So I took 5 companies from that ETF that is basically that are Sharia compliant. And as you can see, some of these ETFs do have expense ratio that is quite high, okay, because of course they are tech companies, they are very high growth companies, they're a little bit more risky and so on, and management has to be top, basically, if you think about it. So what I'm going to do now is I'm going to share with you 5 companies that I extracted from that list, and I'll share with you guys a little bit in detail of each one of the companies. Please make sure you're be careful, because some of these companies are still growing, some of them are very speculative and so on. Right, so the first one is not actually speculative, it's a stable company. It's been around for quite some time, one of the best companies out there in my opinion, and that is Intuit. Intuit is, I own it in my portfolio. It's basically a company that deals with products and services for consumers, small businesses, self-employed. So they have things like the QuickBook services, basically, which is one of their main software if you think about it. And currently, to be honest, year to date is actually only up 5%, when in the rest of the S&P 500 is done absolutely an amazing job. But for the 1 year, it's about 42%. But that means basically since November of last year, it's been going up quite a bit. But just a year to date, since January, basically for the last 7 months, basically, it really hasn't done much. So market cap of 184 billion, has a wide economic mode, $660 right now per share. For the 5-year growth in terms of revenue, 20%, in terms of EPS, 16%, profit margin 19%, return on equity of 17%, return on invested capital of 15% as well, which is really good. So the management are doing really good job, okay, using our capital to of course reinvest in the business and so on, grow that business if you like. Free cash flow is absolutely amazing, $5 billion, 32% free cash flow margin, which is really good. Total return in the last 10 years, we're looking at about 24% almost. Growth estimate next year 12%, then 15% after that, which is really good. Nice double digits there. Premium right now about 27% premium right now, according to Morningstar. $520 per share is where they think the price should be. Now if we go to their earnings expectations moving forward for this company, what we will see if we click estimates, what we will see is that double digits every single year, and when it comes to revenue is exactly the same. So nothing really to worry about in terms of moving forward. According to Seeking Alpha analysts, we're looking about 14 strong buys, 8 buys, 7 holds, and 1 sell, and that gives us about 5% upside from where we are. Almost to $700 per share is where they think the price should be. So $695 per share is where they think the price should be. Right, so that's the first one. The next company we're looking at today is another one that I own in my portfolio, recent addition to my portfolio right now. This is the Salesforce, 249 billion market cap, wide economic mode, $257 per share. In terms of revenue side of it, 22% grow last 5 years. In terms of EPS, compound annual growth rate of 17%, profit margin 15%, return on equity of 9%, return on invested capital of 9% as well. 11.3 billion market free cash flow, which is absolutely amazing. Free cash flow margin of 32%, and total return in the last 10 years, we're looking at about 17%. Growth estimate next year 11%. 16% after that. Fairly value right now $285 per share is where they think the price should be. Right now we're looking at about $257 per share. And just to show you in terms of earnings expectations moving forward, year over year, we're looking at about 20%, 11%, 14%. just if we focus on the first 5, because that's where the most analysts are, okay, then 8%, almost 9% there, 9% there, another 9%. So nothing huge to worry about, from $37 billion to $45 billion, which is absolutely amazing to see. Now, in terms of ratings, we're looking for Wall Street right now, 25 strong buys, 13 buys, 12 hold and 1 sell, and that gives us basically this rate of buy rating, $300 per share. That's about 17% upside from where we are currently, which is basically not bad at all. So both of them agree is undervalued as we speak, and I do own it. It's a new addition to my portfolio, and I will continue to add to it, inshallah, moving forward in the next few months. Next one is ServiceNow. That's 157 billion market cap, very similar to Salesforce, wide economic mode, $766 per share right now. In terms of revenue, they grew that revenue over the last 5 years about 28%, EPS about 30%, profit margin 20%, and return on equity of 28%, return on invested capital of 9%, $3 billion of free cash flow margin of 34%, which is absolutely huge. Total return the last 10 years almost 30%, which is nice. Growth estimate next year is 20% and 23% moving on. These companies are expected to do really well in the next few years. Fairly value right now, $790 per share is where they think the price should be. 766 is where it is at right now as we speak. And just to show you as well the expectations moving forward year over year in terms of revenue side and in terms of EPS side of things, if we focus the first 3 again, 25, 20, 23, 21, or there almost again 21, 20, 20, 16, and so on. So nothing to worry about. Things are heading the right direction, which is quite nice to see. A strong buy from Wall Street, which is interesting. 25 basically strong buys, 11 buys, 2 holds, and basically 1 strong sell. That gives us strong buy rating. Now that means about 11% upside from where we are. $852 per share is where they think the price should be. Really another great company, nothing to worry about. The next one is NetApp. Again, another company that's been around for quite some time, 26.8 billion market cap. It has a wide economic mode, $130 per share. In terms of it hasn't been growing that revenue a lot lately, and the EPS about 7%, profit margin about 15%, return on equity of 85%, and return on invested capital about 33%. $1.5 billion of free cash flow right now, 25% in terms of free cash flow margin. Total return the last 10 years, we're looking at about 15%, which is really good. Growth estimate next year 8%, 6% after that. Right now it's about 18% premium, $110 per share. It's about 130 right now. Now look at the revenue estimates for the next couple of years. We're looking about 6%, 7%, 6%, and then 4%. So moving forward basically for the next couple of years. Ratings, it's a hold according to these guys here. So 4 strong buys, 2 buys, 12 holds. So that for that reason is a hold, and right now it's about flat basically. It's about 2% upside from downside from where we are currently. So again, maybe the one to watch out if it comes down quite a bit, and then you might have to look at the financials again. And the final one is the one that's been going up and down every single day and has gone up so much over the last whatever months. The super micro computer, just in like Nvidia, 52 billion market cap, narrow economic mode, almost $900 per share right now, 21% when it comes to the 5-year revenue growth, and 41% when it comes to the EPS, which is absolutely huge. Profit margin about 9%, return on equity about 30%, return on invested capital about 16%, negative free cash flow almost $2 billion, free cash flow margin of course it will be then a negative as well, 43% in terms of total return the last 10 years, and growth estimate next year about 42%, 62% after that. This is probably why a lot of people are paying high premium for this company. Fairly valued at the moment, 856, 899 is where is that right now. Now looking at this company in here, okay, let's go on. First of all, just let's look at the expectations moving forward. 101% for 2024, 2025 we're looking at about 41%, then 24%, 109% when it comes to revenue, 58, 19, crazy high growth company, right? Ratings, we basically strong buy from Quant. Wall Street is a buy, Seeking Alpha is saying is a buy. Now looking at 7 buys, strong buys, 4 buys here, 5 buy holds, and 1 strong sell. rating right now is a buy, about 15% upside from where we are, just over $1,000 per share. That's what they think the price should be, which is absolutely crazy. So that's the 5 companies that I wanted to share with you guys. So one more thing I want to show you, just to see the performance of these companies over the last few years. So if we just do for the 1 year, we're comparing this with the S&P 500. We're looking at total returns. So this one here, SMCI, 233%. The S&P 500 only 26%. CRM or Salesforce 21%. ServiceNow is about 35%. NetApp is actually 70%, and Intuit 42, 70% and 42% here. Now, when we look at the 3 years, okay, over 2,500, which is absolutely ridiculous. The S&P 500 about 29%. The CRM is only about 5%, which is really interesting. And then 36% when it comes to No, which is actually done better than this. These two are very similar businesses. And Tab about 72%, Intuit 32%, which is not bad. It's closer to it beats the S&P 500, but it's not great. Of course, unlike this one here. Now, 5 years, when we look at the 5 years, this one is 470% return, 85% for the S&P 500, 68%. So they underperformed the S&P 500. This one 161%, and then Tab is actually 150% almost, and 151% for Intuit. So all of these companies are really great companies, of course, and I really like basically a lot of them. But for me, my favorite is the CRM, of course, as you know. Intuit, I like ServiceNow, but these two are very, very stable, and the fact that this one is really undervalued at the moment, I will be adding to it. So when you look at the last 10 years, over 3,000, 180 for the S&P 500, 386 for CRM, which is really good, and ServiceNow 1,300, and Intuit 348, Intuit 776 as well. So finally, going on show you the Sharia compliance side of things. You can pause the video, have a look at that. So nothing to worry about. All of these companies are absolutely fine. So that's the companies that I want to share with you guys. I hope you're enjoying this type of content. If you are, please join us in the Patreon account. It makes a huge difference, of course, for me. So have a wonderful day. Assalamu Alaikum.